generally innovation is going to be on a continuum between enablement and disruption. And enablement are those technologies that Brad is sort of referencing that just make it easier and better to do your business as you're doing it. And disruption is what I once heard someone call, take your business out behind the garage and shoot it, right? So I think people sitting in this room are largely coming from the incumbent industry, and there's often a lot of focus on these enablement platforms. But I think it's equally important to be thinking about the true disruption that's coming in the industry that can sometimes just change the industry very, very quickly. And so I think we will see innovations that do come from adjacent industries. With Proptech, we're particularly seeing kind of a coalescing between Proptech and FinTech. That makes sense because capital markets are such a significant part of what we do in the industry. But I think that what we all also need to be aware of are there are going to be ideas that are unique to our industry that really are like truly disruptive, that I think are going to have as much impact on the way that we do our business as some of these ideas that create incremental change.
I think your point about the flywheel is a great one, right? You think about the PayPal mafia and how they went on to found so many of the significant companies in the general tech space. Now you can think of the Starwood Mafia or the Invitation Homes Mafia.
Or Trulia.
Or
Trulia is actually one of the most significant mafias in that Eric Wu worked at Trulia, Sean Black worked at Trulia, Pete Flint, who is the founder of Trulia, is an important VC in the space. Paul Levine, who is the president of Trulia, is an investor in the space. So you do have these little niches. Zillow is now doing it, right? And I do think you see businesses spawn other businesses. Certainly, we see that in FinTech.
There's expertise, there's access to capital and relationships, there's all of that. You made a point about disruption. I'm going to ask both of you this because you're a big investor in this space that I'm thinking about. Disruption also breeds fear, and it breeds fear of obsolescence, right? And so we have a lot of agents in the room. We've often heard of technology. Expedia got rid of travel agents, for example. You didn't need travel agents anymore. Hotel Tonight gets rid of a lot of those rating sites and all of that. So there's a lot of fear around agents and technology, which is why there's often resistance to technology. Brad, maybe you want to start us off, because you're a big investor in the iBuying space. Opendoor and in Latin America, I forget the name of that company in Latin America.
Loft.
Right. So when you think of something like iBuying, and there's this disintermediation of the agent, how do you respond to that? How do you think about that from an agent's perspective?
Yeah, listen, I think we view it as less of a disintermediation and an evolution, in the sense that, listen, I don't think Opendoor went to the market initially with the idea that, hey, we are 100% doing this to disrupt agents. It was mainly a pursuit of making the home buying process less painful, and that primarily had to do with the ability to sell your home quickly and mitigate the frustration of putting it on the market.
But don't you think, in a twisted sense, agents kind of want the home buying process to be a little bit painful?
Yeah, I get that.
Title insurance agents want it to be a little archaic.
For sure, but again, like if we're trying to serve as the customer, we have to make that consumer experience as pleasant as possible. And in doing so, it opens up opportunities that I think we might be short-sighted in thinking of, hey, with a better customer experience, what other services and processes and technologies could we be providing and creating opportunities around? So it's really more of a function of, when we look at opportunities, the thesis for us is never we want to get rid of agents. We think agents are a very important part of the process, and we don't think they're going away anytime soon. Selling and buying a home, these are the most important financial decisions of most people's lives, and there's no amount of technology that's going to get someone comfortable by completely disassociation with the human element of that process. And agents provide that really well. So I think for us, it's more along the lines of, hey, it's not necessarily taking the idea to the back of the shed and shooting it, but it's considering, hey, like, should we buy another dog? Like, this one's old, and we love that dog, and we should give him a nice send off. But like, let's get a new one because that one presents significant opportunity. And if we think about the equation and the opportunity more three-dimensionally with more options, everybody wins long term. So it's really more that.
Being sentimental isn't being part of being a VC, I guess.
And I'm drawing a very thin line because there's a lot of probably dog lovers here, and I love dogs too. So I'm not saying don't paint me a dog killer.
Kevin, you want to make a point?
Yeah, I would just to jump on Brad's coattails there. I mean, you can look at a problem or a challenge as being the yin and yang of a way to look at an obstacle. And I would say, I mean, if you want to be negative or you want to instill anxiety, call it disruption. But really, transformation, I think, is a healthier way to look at it. And one of the phenomena that, and I'm going to say Brad and I have been on the journey along with a number of others in the last 5 years in particular, but the degree of collaboration that's evolved in the real estate industry in particular, if you look at the last 5 years compared to the last 30, has been astounding. And so when we first met one another, Brookfield and Fifth Wall, along with Blackstone and Oxford and the Hines organization and a number of others, number one, we started sharing our experiences about how technology could be used to improve productivity, not eliminate people, but to elevate the quality of the work that people were doing. So instead of like I'm going to say Honest Buildings, which many of you may know, Riggs Kubiak was the founder, is now part of Procore. What we found is we saved 69% of the man hours that were involved in beginning a capital management project at Brookfield. And what it did is it prevented people from needing to rip open envelopes and input information into Excel spreadsheets and put their time and energy into much higher value activities. We accelerate that, and now what the organizations that I just mentioned and others are doing together, all right, is identifying emerging leaders in these new categories and supporting them with the collective business from those organizations. But of equal importance, not greater, not less, is investing in those companies as a club, different organizations, both the venture community as well as strategic investors like Brookfield, putting their money where their business is and helping these organizations develop scale, all right, in an accelerated way. And it's the big obstacle is change management. It's people learning to do something a new way, just like we didn't all used to have telephones that were right next to our head all the time, 24/7, or at least in our pocket, right? It's a different way of doing things.
Yeah, and I think that's an interesting trend that you guys have really jumped on, right? Having LPs from the industry, raise money from them, they invest in these startups, and then you go back to those LPs who have these giant portfolios and say, try these out. Let's pilot test them. Let's iterate. That's the model.
Venture capital is a risky business. There's no doubt about it. And historically, venture capital has been generalist. Yeah. And the reason being is that venture has typically focused on investing in net new categories, categories that didn't exist. And that sort of spawned all these amazing new inventions and industries. Sort of social media being one of them. At least in the last 20 years. And as that opportunity persists, just specialization started to rear its head. Why? Because as technology sort of ceased to be an industry unto itself and started to reflect the industries that it serves, you started to see massive categories. And real estate and real estate capital markets is the biggest industry on earth. And the idea that that industry is, for the first time, waking up to the idea of adopting technology, that should and is already starting to create a massive category. And the problem is that those generalist VCs typically have never worked in the real estate industry. They don't have those relationships, they don't have the context, and they don't have the contacts. So being able to form a firm like Fifth Wall and put our years of expertise in navigating the real estate industry and the tech world and providing incumbents an ability to enter that space as well alongside us creates an amazing platform to not only identify the next great winners in the space, but de-risk the outcome in the sense that when you can invest in a VC knowing that you have significant commercial adoption coming from a consortium of investors who've expressed interest in leveraging that technology to further their business, it makes that underwriting process a lot easier.
But you have had generalist VCs come into the space, writing massive checks. Clearly, I'm going to go to you on this, at incredible valuations, right? You saw Tiger Global run through this business, right? Massive checks. I'm not sure how many of those investments are above water right now, but what does that do for an industry-focused VC, such as yourself, when someone comes in and just writes and goes riot?
Well, I kind of sit on both sides of the fence here, Hiten, since I just spent several years working at a generalist VC. So,
but I will say that in those years, you didn't see this kind of madness. The SoftBank money, the Tiger Global money in the last 5 quarters has been crazy.
I mean, I was at BCB during that time, encouraging Tiger in particular to mark up our, but I mean, Tiger aside, I actually think it's a net positive thing that we have the generalist VCs becoming more and more interested in Proptech to that, that flywheel point. And, I think there's always things to learn from both sides of the fence. I very consciously made a choice to leave a highly specialist fund, Metaprop, and to go and work at a generalist fund. I'm actually the only specialist Proptech investor at this point in the country who spent meaningful time at a generalist fund. And I think there's value in being part of a partnership of people who have just been venture investors, because there is a certain type of pattern recognition around the way that companies grow, around the types of issues that young companies tend to face as they evolve. And so I do think that there is enormous value in real estate expertise, and I have to give Brad and Brendan a lot of credit, because I also think they recognized something about the way that they could almost create a franchise, bringing together these different parts of this flywheel. But I do think generalists getting involved in this space is net valuable for everyone. And it's not just because funds like Tiger are bringing their, primarily public markets driven capital writing power. And one of the reasons why Tiger can write the sort of checks that they can write is because they have LPs who are looking for returns that aren't really venture returns. They're returns that are more aligned to the returns in the public markets. And it's my opinion that somebody like Tiger is functionally creating an ETF of the private markets. So they have the flexibility to come in and say, if we get this much cheaper than what we would have paid for it in the public markets, it's still a benefit for us. And that is changing the game of venture writ large. That's not about Proptech. That's just changing the venture game. And I think Tiger's going to end up being successful. I know that the valuations look poor right now. The entire NASDAQ is down. Proptech stocks in particular, some, in the resi space are almost 80% off their highs. But I still am, I'm bullish on this sector. Can I just very quickly, Hiten, go back to your question about residential brokerage? And
Please,
how
I was going to bring your
The best
former,
person to answer that question by far.
just for context, in Clelia's former life, she was the president of Warburg Realty, so has pretty good insight on that world.
Yeah, so this is, I got into the real estate business because my dad was a real estate agent who had grown a brokerage business in New York. And so I understand, I think better than most people, the level of professionalism and hard work that goes into being a top performing real estate agent. And so I would say across the venture landscape, we've accepted at this point that disintermediation is not going to happen with good real estate agents. I do think that we're going to see what I often describe as 3 layers of disruption. And at the bottom, I think we're going to see iBuyer type models. I think those models are going to happen in places where there's lower complexity and lower price points. So, Phoenix is the classic example of places where iBuyers have been very successful. And that's because the inventory is actually relatively consistent. And the
Cookie-cutter
price,
homes and all of that. Right.
and that makes it much easier for algorithmic driven pricing to take place. There is no chance that iBuying is becoming a significant part of the New York market or the Miami market or, any place where you have high value, high volume, and high complexity in the market. But I do think we will see some portion of the country start to use an iBuying model. I then think that we'll have a layer in the middle that I often refer to as neo-brokers, where you'll combine sort of a digital transaction backbone, often with an employed agent model, because the thing about employing agents is you can then oversee their behavior in a much more consistent way than you can with independent contractor agents. And for certain people, that is a better option. It also means that you can give them sales quotas related to secondary services. And one of the big things that we're seeing in the brokerage space right now is this idea that the agent will be the quarterback of a bunch of other transactions, and that's what will drive value. So even Compass has for a long time said that the way that they're going to sort of turn profitable is they'll effectively become a marketplace for other services that will be sold via their agents, and those other services are higher margin than the existing brokerage business is. But no one has ever proven they can do that with independent contractor agents. And so I think at the top layer, then you'll have a sort of golden age for being a top performing agent. And everyone and their mother will be throwing these really interesting tech platforms, tech opportunities. You have businesses like Compass, like Side, that are being built just targeting this group of top performing agents. And I think the big question, and this is a somewhat painful question for me given my family's business, is will brokerages be disintermediated? I don't think agents are getting disintermediated, but I think there is a legitimate question about whether brokerages are getting disintermediated.
Why do you need that entire infrastructure around when it comes in? I guess to your point, to make it's easy to iBuy or algorithmically price a cookie cutter home in Phoenix or South Dakota. How do you do that for a Classic 7 overlooking Central Park, right? That's the idea.
It's always good to sort of refresh expectations, sort of reset the expectation of what does it mean to build a sustainable and lasting business, because sometimes we get caught up in the fervor of VC and growth at all costs, and sometimes we forget about the purpose here is to build a business that generates revenue and returns.
Business has to be revenue greater than expenses over a long period
100%.
of time.
But
Right?
I started Imitation Homes in the depths of the housing recession in 2011. That you would have thought that starting a business then would have been crazy, but we started it based on the contrarian bet of there was money to be made in professionalizing single-family rental homes, and then we spent the time and energy, raising the capital and building the platform to do it, and now that's proven out as extremely, sort of sustainable and profitable and impactful business. So, sometimes downturns are the best time to start businesses. So we really view it as sort of this optionality to enter the space and invest. Dry capital is actually a real opportunity for us.
And for investors, it's a good time, right? It's more competitive deals, and you can call the shots a little bit more. I'd want your experience or your take as a founder or an executive in a startup in this space. The world changed very quickly, and how did it turn out?
So you're talking about with Willow now? With
Willow now, as opposed to 6 months ago when the markets looked quite different.
So I personally have had the benefit of being through or living through and working through a whole number of corrections since the early 80s. And I'd say that consistent with what Brad just said, the thing to focus on is the flight to quality that's going to take place, I believe, over the next 12 to 18 to 24 months. There's plenty of capital. But it's at the margins when there's been huge losses, whether you talk about a Tiger or SoftBank. But there are still fundamentally some terrific companies that are well run, that are profitable, that haven't traded on multiples that don't make any sense. So to the extent that there continue to be ideas and market demand for businesses that are well run, they're either profitable or on the road to profitability, okay, and they're growing, I think that there, number one, is going to be great opportunity for those, and I count Willow among that group of companies. But I also think that there's going to be some consolidation that wouldn't have happened before, but is now circumstances are going to force, which I think will be a positive outcome, and it'll aggregate customers together, it'll aggregate companies, it'll aggregate the smartest people who are running the businesses the most effectively, and just to make it clear, I really do believe that Willow will be among the leaders in the consolidation of those companies. They're looking to create a digital twin or a platform that allows for the integration of all of the other technologies that are associated with a building, and the outcome is really what we're after. We build a digital twin, we deploy it on a cloud platform. Currently, we do that on a Microsoft cloud platform so that it has a global availability. What that ends up doing is it allows for the aggregation of data in one place in ways that have never been available in the industry. It was said just a moment ago that the real estate industry is probably a 30-year laggard in the adoption of technology. Well, it's the technology coming into play that's going to allow for the aggregation of data, because that's really where we're going to make money, we're going to create value, and that's what's the driving force behind the best technologies that I think are going to thrive in this environment.
I want to end on sort of a very, very big topic that started off as kind of just something you throw out there, which is sustainability. People sort of, their eyes glaze over, they start falling asleep. I remember when we started writing about greening real estate, just the traffic to those articles was close to zero, right? Suddenly you're seeing a lot more momentum. How has it shifted, Brad? Maybe we can start with you, from just a buzzword to a movement. What was the fundamental change that happened? It's not like real estate is now more pollutant than it was, but something switched.
Yeah, listen, I think the equation's changed. I think obviously when regulation starts to kind of rear its head and start to point towards the industry, it obviously generates a response. And with some of the recent regulation that's been passed in cities like New York and LA, with the US rejoining the Paris Climate Accord, and I think with the general consensus that corporations need to have more responsibility on their impact on the environment, there's been, I'd say, a renaissance of thought here that I think is much different than what we experienced during the Green Revolution of the 2000s. And the biggest driver, if I'm being honest, is this government-mandated demand. Non-compliance is going to result in significant financial implications. So that's a good motivator. But money only takes you so far. And I think what we're seeing also is that corporate stewardship is resulting in a desire to articulate a transparent and thoughtful sort of sustainability strategy to answer the call, which is real estate is 40% contributor of global greenhouse gas emissions. That's essentially the biggest culprit in the world. Everybody associates greenhouse gas emissions with transportation and these other industries, but it's actually real estate is one of the largest, if not the largest.
But why did we just start hearing about this dramatic number a couple years ago?
I think
no one really stitched it together.
I think there's a real fervor around this. You know, I think for millennials and Gen Zers in particular, who are going to be the majority of the workforce of the future, this is their new religion. You know, this is the most important item on their list, and it's what they focus on in a real and meaningful way. So whether or not there's a government regulation pointed at your building saying you have to reduce carbon, there's many instances, and some of the big tenants are actually articulating this, where Google, Facebook, others, you know, I don't care if you don't have, if your government's not forcing this, here's what we expect out of this building. Why? Because our employees don't want to work in a building that's contributing to this crisis. I think there's lots of opportunities to take advantage of this, whether it's, you know, satisfying consumer demand, mitigating insurance costs, creating operational efficiencies, attracting lower cost of capital, positioning yourself well in public markets, you know, meeting government regulation to avoid fines. All these things are creating a real impetus to actually spend the time, energy, resources, and more importantly, capital. And it's gone well beyond sort of GRESB reporting. This is about changing the business to accommodate this in a meaningful way.